All right, we're live. And Justin, you're in Northern Virginia, right?
You got it.
Does that make you Commanders, Capitals, Nationals fan?
It does not.
No.
Lions, Tigers, Pistons, Wings.
Oh, you went to the University of Michigan. I was trying to get through the show without bringing that up, but there it is. So,
Uh, Off the bat, hey, that's just a Detroit thing. It has nothing to do with Michigan. I mean,
so
so
You have a
you're so you
horse?
were you born and raised in Detroit?
yeah, so like right in between Detroit and Ann Arbor. So
Okay.
I was about 20 minutes from each,
Okay.
right there. Yeah.
The Tigers look incredible this year. Their starting rotation looks really good. As a diehard Tribe fan, I've got my eye firmly, even though we knocked you guys out of the playoffs last year, but they look very good this year. It's so.
You remember a baseball player named Jody Garrett?
Oh yeah, you play on the
Yeah,
Tribe, our right
yeah,
fielder. It's the
he's
last
an
Indian.
awesome
Yeah.
he's an awesome mortgage consultant for Prosperity. So
Is he really?
he works in Chicago. Yeah, he's a great asset for us. Yeah.
It's hysterical. He's a popular Cleveland sports trivia question going around. The Indians have not had a outfielder to hit 20 home runs since Jody Garrett.
There you go.
The last, so um,
Rich, have him on the show next week.
that's cool. He might have made the All-Star. He had a one or two incredible years here in Cleveland, Jody Garrett. So, and he was known as just a great dude. So you'd know
He
better.
is. I mean, hands down. He's fantastic. So we're lucky to have him.
That's awesome. Very
Yeah.
cool. So
You
good.
wonder there has to be tens of thousands of retired professional athletes between football, baseball, basketball, hockey, golf that are roaming around, places like Florida and Texas.
Yeah.
So,
Yeah. All
right,
with all with brain injuries, but
especially as golfers,
Yeah.
tennis players, a lot of retired athletes out there.
all right. Well, let's go ahead and get into it. My name is Rich Swerbinsky with Onward and Upward Consulting, and this is the big picture presented and sponsored by our great friends and partners at Depth. 20 years of so ably serving the mortgage industry, the fintech industry. Had the privilege of spending some time with the Depth team earlier this week, and just pros to the nth degree, and just a great organization for having your story told. And you can check them out at depthpr.com. You can get a hold with us, and we can get you in touch with Carrie, Leslie, Lindsay, and the team. Rob, your hands up already?
It is. So there's a lot of urban myth out there, Rich, about the depth offices or the
Mm-hmm.
office complex.
Mm-hmm.
Uh, some say it's built on a hill overlooking a moat.
Mm-hmm.
Others say that they uh, own the campus itself. And what are the offices like? Or is it like really roll up your sleeves, bare knuckle, uh, you know, nose to the grindstone kind of place?
It was incredible space. They have like a shared space situation that is so cool. I really, really enjoyed it. Just where they have like, part of like an open like workspace in just north of Atlanta and the Buckhead area. So it was great. And yeah, very conducive to a good meeting, and not surprising that yeah, they had a very, very, very nice space. So
Good, good, good restaurants nearby, easy parking.
yeah, yeah. I stayed in Buckhead and just Ubered, everywhere. So it was easy, and yeah, good times. So I actually left my office, Rob. You should be proud of me. So
Well, I wasn't going to go there yet, but yeah, I mean, the what'd you do with that ankle bracelet? Did you wear that down there that the corrections department assigned?
once I get past the threshold and get the shock,
Right.
yeah, it's fine after that. So good stuff. All right, and joined as always my esteemed colleague and co-host Rob Chrisman. Rob, how you doing this week?
I'm doing well. Thank you.
And this week, very, very pleased to be joined by the CEO of Prosperity Home Mortgage, Justin Messer. Justin's an elite guest when, he's a Michigan grad, and we're still pining to have him on the show. So Justin, uh, good to see you. Thanks for joining us.
Of course, guys.
All right. Well, Rob, I got to start. Obviously, the Fed meeting and announcement yesterday, the Fed holding the fort, holding rates, pointing to quote unquote tariff uncertainty. Uh, of note, the first trade deal gets done today. President Trump with England, so stock market very positively reacting to that. So we'll follow all those developments, see how it all plays out. And but Trump, of course, then comes out and calls Powell a fool. And at this point, really, I mean, it's he's and then of course said he would never fire him. Why would he? He's got his scapegoat, right? I think for if things don't go the right way. But why, and Powell is in a really weird spot here. We've talked about this before, but just fascinating. And also of note, UWM lost $250 million in the first quarter. Thought that was interesting. And then it cracked me up because Ishbia, it's because of our servicing write down. Yet the previous quarters, when the only reason they had a profit was because of servicing, it was no problem then. But now, the servicing markdown was the reason. So as always, Rob, I throw at you the top news of the week and let you get us rolling here on the big picture.
Well, I will say I'll take the easy one first, and that's the Fed. Everybody expected the Fed to do nothing, and yes, you and I have talked about the Federal Reserve before, and I'm a firm believer that the Fed's mission is to lend stability, add stability to the U.S. financial system, and so for the Fed to do nothing at this point seems prudent to me, at least, because you don't know what's going to happen with inflation. You don't know what's going to happen with tariffs. You don't know what's going to happen out there, and the fact that so there's some kind of joke about, or some kind of comment, Rich, that you can, if let's say I'm in Justin's office and I'm hitting him with a little ball peen hammer, just tapping him on his head, on his head, on his head. And he's like, oh God, this is a real nuisance. This is really chaotic. I can't think. And then I stop and I say, you need to thank me for stopping hitting you with this ball peen hammer. And is Justin supposed to be gracious and full of gratitude? No, he's like, why were you doing that in the first place? Well, that's the analogy that I'm hearing out there with regard to any kind of agreement that Trump signs regarding these tariffs. It's the situation has been brought on by Donald Trump. And yes, I've heard that the tariffs were put in place to about, fentanyl. And then it was to correct our trade imbalance, and then it was to help our overall budget deficit and so forth. I mean, there's a lot of reasons that have been batted around, but for an agreement to be agreed to, I think is it's great. But, from my perspective, there wasn't a lot wrong ahead of that. So anyway, good. Donald Trump has something to talk about. And you're right, he does use Jerome Powell as a scapegoat. And Jerome Powell's in a tough spot. And the Fed isn't there to predict where interest rates might go. There's data, current and past. And I know that you think that their data is old and stale, that they typically look at, and they should be more forward thinking. And there's a lot of people who agree with you. But for now, who knows what's going to happen? Who really knows? Should Jerome Powell take a chance and lower rates? Those rate cuts are priced in the market to some extent. Some of the brighter minds out there are predicting interest rate cuts by the Federal Reserve, 2 or 3 or 4 by the end of the year. And then the question is, okay, what if the economic conditions stay where they are now? Does the Fed really need to cut rates? So it's always a little bit of a guessing game. Forecasts are tough to deal with, and through it all, mortgage companies and lenders and vendors just keep trying to help their clients regardless of what's going on with tariffs and what's going on with interest rates. So I'm continuing to see that. Like, okay, that's great. The big boys can talk about interest rates all they want, but how are we going to help our borrowers?
Other news this week, Justin, your boss, Warren Buffett, hung him up this week. So you ever get a chance to play 18 holes with Buffett or any?
One time I was in a stadium where he was at. It was I was Buffett adjacent for a minute. Yeah, but end of the year, I'm gonna hang it up and move on to the abled, no pun intended, hands of Greg Abel. So we're excited about that. We know Greg pretty well.
And Justin, if you could
wait
go.
a minute, wait a minute.
Mhm.
What stadium, what event was this?
It was at the shareholder meeting. I was there. Actually, funny story. So I was newer to the kind of Berkshire Hathaway family, and I got this invite to go to the shareholder meeting. So I'm thinking, hey, this is going to be great. It's going to be. I'm going to get a behind the scenes view of everything. And the day before I got there, I got an email and it said, hey, make sure you wear comfortable shoes. That's interesting. Comfortable shoes. Okay. Turns out I was working the Berkshire Hathaway Energy booth in the marketplace, the awesome marketplace. So it was still an awesome experience. I got to jump in and see part of the shareholder meetings maybe 3 years ago. But kind of a funny little sidebar about how massive Berkshire Hathaway actually is when you
Did you get any free Seas candy?
I know you have to pay for everything. So yeah, I bought some Seas.
Is that part of the Buffett empire?
Yep.
Oh, is it really? Okay.
Yeah.
You always
It's
see.
wild when you walk around there. You see the disparate businesses, and it's like it's pretty mind-boggling.
Interesting. And
A
Justin,
lot of insurance company trains, right?
Trains, planes, automobiles, like NetJets. You got the railways, you got Clayton Homes, you have the energy utility conglomerate, just to name a few. Then you'll have pontoon boats, Fruit of the Loom, and Duracell right in the middle. And it's just really fascinating to see the power of it.
And
Yeah.
Justin, if you could tell our listeners and viewers just the background on Prosperity Mortgage and some of the recent developments that have taken place with the company, and yeah, just if you could.
Yeah, just real quick. So, Prosperity primarily focused, we're real estate brokerage owned, so we're a real estate affiliate. So 50% of our production comes from affiliated real estate entities. We have about 49, 50 brands throughout the country. We do operate in 49 states. We're owned by a company called Home Services of America. Generally, that's not a name that is known because that's not really a brand name that's on the street. Instead, that is kind of like a holding company for all of these various real estate companies throughout the country. So again, we affiliate with individual local brands in different markets, which you may or may not know. Our kind of flagship franchise brand is called Berkshire Hathaway Home Services, so BHHS. So if that is in front of an entity, that is part of us. And then we have, in a ton of markets, we own and are affiliated with either the top or the top two, one of the top two, like kind of, I would say privately branded, companies in the market. So that's our primary driver. Call it 40,000 agents, and then double that when we expand it out throughout the franchise network that we kind of service.
And JD Power, #1 ranked mortgage company, if I remember correctly, right? In customer service for 24. Do I have my stats right there?
I mean, I have it behind my shoulder
Oh, there
here
it
because
is.
I have to
Okay.
remind myself
Okay.
of what it is. I started my career and learned, everything I knew about mortgage at Quicken Loans. So to steal JD Power from them
Right.
was pretty awesome. But hey, we learned it all there, and I mean, it's really blocking and tackling, around this kind of thing, which is instilling a sense of urgency and who the customer is, to every single member of the team. I mean, maybe 3-4 years ago, we started on a mission to kind of redefine customer. I'll just really quickly to like our ops team, right? And our entire back office team, because they kept thinking the borrower, the borrower, the borrower. But in our model, like it's the borrower, it's distributed retail, so it's also the MC, right? And then it's the real estate partner that's in the transaction as well. And then anyone else we interact with. But like changing that mind frame to them from I came from a consumer direct world, so really the borrower is your client, right? And that's your focus, and that's pretty much it. Adding these other people in there and having them understand the stakes of the transaction, really changed it. And then, hey, we won an award, which maybe means that we were doing something right. So we're pretty pumped about that.
It's interesting how when I was growing up in the industry, like Orange County or Dallas, they were the mortgage hubs of the world almost. But in recent decades, certainly Michigan and Ohio have really risen to prominence in terms of lenders and vendors.
In college
Florida.
football, for the record, last 2 national champions. So,
okay. All right. Anyway, interesting. So
we also have the best sanctions. I mean, Ohio State had great sanctions. Michigan, I mean, we're good at that too. We're keeping up with the Joneses now.
Dueling sanctions, exactly. Right? So. So just in the real estate, you guys, very large national real estate owned mortgage company, such a fascinating model. What are some of the unique just advantages, I guess, and challenges of that model?
Yeah, I mean, the advantages are easy. I mean, I think, as people have shifted from, or I'd say shifted to primarily purchase, right? They found that the toughest thing probably is getting the attention of agents, right? And how do you set those meetings? How persistent do you have to be? How do you do it? And I think being a real estate affiliate, the one advantage we really have that I try to tell people, because I don't promise them it's going to be a panacea and they walk in and they immediately grab, $50 million of production. But we can generally set up the meetings and the introductions, so we can make that happen. We can encourage that and then show the value add, right? So that's really the advantage of the model, right? We get to co-locate with agents to the extent that they're still in the office, which not many are post COVID, right? But hey, we have a presence in the office, we're there, et cetera. And we're also going to be like the trusted lender in the transaction should they need something. So if they don't have a lender, the default is going to be us, to say the least, in the office, right? But beyond that, like that's really the advantage of the model. The disadvantages are, and it's not really a disadvantage, but what I'd say is being the affiliate lender in a real estate office, we are held to a wildly different standard, in my opinion, than kind of the outside lenders that are in there, right? Because if a realtor is going to say, hey, I'm going to trust my transaction with Prosperity, who's my affiliate, they really feel like they're putting their reputation on the line times two since it's an affiliate. And the stakes are higher because they have to clarify to the home buyer, hey, I'm not getting anything out of this transaction. They always have to overcome that, right? So that puts us at a bit of a I'd say the need to deliver is 100%. Like it's not, again, if we look at a consumer direct model, hey, you might mess up a deal or two. Maybe that's okay. You just impact that sphere. In that real estate affiliate model where I'm there and I'm embedded in the office, if I mess up a deal, that can have ramifications for years in that individual office and in that sphere of influence of that real estate professional, that broker manager, and the confidence of Prosperity. So that plus, I would say, we are generally put in competition with other lenders, on by and large in the majority of our deals. So agents often still are in the cadence of referring, a few different folks, especially when one of the folks is affiliate. So it does have some margin compression for us as well in the model.
And then, Justin, it's been a year since the NAR settlement, a little over a year. It was such huge news a year ago, and just led to a lot of discussion, speculation as to, how things would play out on the real estate and realtor side of the business. To this point, it hasn't. Surely there's been some changes, but I don't think not nearly to the degree that many predicted or anticipated. And then now we've got this big kind of hubbub with the private listings and Compass, kind of embracing private listings and homes that aren't on the NMLS, and all the other essentially real estate brokerages kind of coming out and giving their thoughts on it. What your thoughts on that? And I guess beyond that, the plight of the buyer's agent, where many kind of predicted their demise. At the same time, we haven't really seen that. We have seen a little decrease in commissions, but nothing crazy. Would just, yeah, welcome your
Yeah, I mean,
perspective.
yeah, nothing super significant. I would say like we don't view it as statistically different from before the settlement. The good thing is it's become very transparent, right? So like I don't think any of us would ever vote against a transparent marketplace, and I think that's what it's become, to the extent that hey, everything is disclosed, everything's up front. I never think the intention of anybody was not to disclose things or do it up front. I just think that systemically, creating documentation just like we did in mortgage, right, to make things clear to the consumer is always a net positive. I think just like with the buyer agency choice, along with the private listing choice is never a bad thing for consumers, and nothing is generally a one size fits all, right? So our private listings, for example, are they right for 100% of the listings across the country? Absolutely not. Is there a select group which they probably are beneficial for and the preferred choice of that consumer? 100% as well, right? So those things, they don't have to be mutually exclusive. Same thing with buyers agents. Is getting a buyer's agent right for 100% of the people in the country? Absolutely not. Is it the right thing for the vast majority of folks? Probably. And we just see that statistically, This predates me a little bit, but I do know when in terms of the real estate industry, when the focus became on the internet, right? It was, well, we're never going to need buyer agents again, and the percentage of people actually attached to a buyer's agent is higher than it was like in the late 90s and early 2000s. So if you think about that, it's the internet provides a lot of positive, right? It just doesn't provide yet the convenience in the actual transaction, right? So what do you want? Like, I think people value convenience over anything almost these days, right? So, the convenience and the simplicity of having an agent kind of do all of that legwork for you, I think really, really outweighs, much of anything else. And people are willing to pay for that as long as it's a great experience. And, you know, it's kind of what we focus on, right? The kind of one-stop shop concept of, hey, you come into a real estate professional, and should they choose to, and should it be the best thing for you, they'll work on every leg of the transaction for you, and we'll work it on the background, and we'll just get you in that house. So the only thing you're worrying about is the drape color, as opposed to all the nuts and bolts of the transaction.
And then, of course, Rocket, buying Redfin, and then Cooper, couple weeks apart, obviously made huge news and splashes in the mortgage industry, led to a lot of just debate in our industry about, what that means for the future of the industry, what it means for small lenders, and the closing connection between, real estate brokerages and lenders. As somebody that's kind of deeply embedded in that world, your thoughts on the transaction and, like from the Rocket perspective, challenges in absorbing that, or maybe how you see, things playing out in that arena for him.
I think it was brilliant. Every piece of it was brilliant. I mean, if I were to draw it on a whiteboard, I would, I may change who the companies were, or but having connecting all the legs of the stool like that. And like, let's not forget Rocket Money in front. I think that's a big one as well, that probably is undersold in terms of how this works in the ecosystem, right? But I think it was a brilliant move. I'm still very curious about what their actual plan is with like the Redfin employee agents. Like, I have no idea, and I don't know that they've spoken about that, right? Is that going to be a model that they keep, or are they going to change that around? I think it's interesting. And then we'll have a better idea of how it's going to impact, what I would call, again, people opting into buyer agents. I mean, it's really the last mile concept, right? So in other words, Zillow can get you, just like Amazon, they can get it to the warehouse and they can get you there and then get it set up. But really where rubber hits the road is that kind of last mile of actually, I'd say conversion and delivering that actual sale or whatever happens to be. So what's Rocket's strategy going to be there? Is it going to be to utilize independent, real estate professionals like they do today? Will it be flipping a little bit to the employee agent model where they can? That'll be the interesting thing. I don't think there's any question about whether or not they're going to execute like champs on the Mr. Cooper aspect. I think they're going to absolutely crush that. I don't think there's any question in my mind. The Redfin might be a little bit more of a guess and check because it's a little bit different, and it's bigger than Rocket Homes, I think, as it currently exists, right? So that'll be a different challenge for them, but I'm sure one that they're up for.
This is The Big Picture, presented and sponsored by our friends at Depth. And as always, joined by my esteemed colleague and co-host, Rob Krisman. This week, the CEO of Prosperity Home Mortgage, Justin Messer. Justin, this has been a kind of crazy cycle, about 3+ years into a bear market after 2 years of just pandemic-induced madness. And just curious your take, like how have consumers and referral partners behaved differently in this cycle, being so close to both parts of the transaction as you are at Prosperity?
Yeah, well, I mean, I'm sure Rob's seen it before, but this was a little bit of a different cycle for me, from a standpoint that everything was stubborn, and I think mortgage underperforming at the same time, brokerage kind of struggling and underperforming is something we don't generally see. If we see trouble in housing, generally we see a lifting tide or rising tide in mortgage, right? Because rates are reactive. So for rates to continue to rise in the face of a difficult market for brokerage was a new challenge for sure. And so to your point, exactly what we had was, I think mortgage was struggling to, maintain the ground and remain profitable to the extent we could, or at least not lose all the money, right? So stay there, while agents, every single deal was, life or death for a lot of agents, right? Because their deal flow just absolutely crumbled. And so it's like, hey, if they're going to do one deal every 3 months, are they going to trust that with Prosperity? What is that going to look like? And that changes my obligation to the transaction as well, because now I feel like ultra obligated to make sure that someone can make the car payment or do this, not only from the mortgage consultant's perspective, for sure, on our own team, but also the real estate professional side on the other side of the transaction. So I think the intensity really, really, really amped up. So intensity amps up while volume is kind of lower. I think it was a tough scenario, and you're trying to staff correctly, right? And you don't want to overcorrect there, because if all of a sudden your service levels drop off in that environment, you can't survive, because you blow a couple deals like that. Like I said, the knock-on effects of that, if you cost someone a commission, is deafening. I think from the consumer standpoint, I mean, at this point, finally, I think we're seeing kind of reset, and expectations aren't, about, hey, that hope in the future that something's going to happen. I think people are acceptant. Around 50% of our purchase transactions are first-time home buyers. So really, if you think about that, like, what's the comp, right? The comp is rent, and rents have been increasing. So if you look at that shelter cost, like it's one or the other. And I think that's still, there's a really, really good logic behind, buying as opposed to renting, right? So our competition there is pretty it's going to be driven by rates the same as anything else. That famous like lock-in effect that we keep hearing about, it's for sure real. The conversations I have the most often are around that, and people like not understanding why people would need to sell. I also think that a lot of those people are disconnected from reality, which is like, I don't know about you guys, but my wife reminds me like once a week that we don't have a mudroom, right? And she's just like, if we just had a mudroom, and I'm like, but our rate is 2.625%. She's like, I don't care. We don't have a mudroom, right? So like, eventually, those domestic conversations occur in a house, right? And there's expansion, there's death, there's divorce, there's all these natural things that occur, and so we are seeing it thaw a little bit, because people just stop caring, and they realize that there is no savior out there that's really gonna I think make things super affordable. I mean, I don't see, and I wish I did. I don't see the structural shift that happens to make home prices all of a sudden become significantly more affordable, just based on supply and demand demographics that we have right now. I mean, it's really tough. I wish I saw it, because I think even brokerage real estate professionals, I think we all wouldn't hate if appreciation kind of leveled a little bit, and we got back to a little more reality of affordability and let wage growth kind of catch up a little bit. I think that everyone wants a healthy market. And I think we've been running a little quick for quite a while without a super clear end in sight. I'm sure it'll happen, and then it'll look obvious to us after it does. We'd go, oh, of course that's how it happened, but I don't see it right in front of me right now.
Yeah, the nightmare scenario is if, I think we're going to see a lot of things done in the summer to help stoke supply, help for the home builders, selling federal lands and developing it, and other initiatives. But if that scenario, that's the one that does worry me a little bit with all the home price appreciation we've seen. If we do a lot of things as a country to stoke supply, which is greatly needed, but then the interest rate piece of it, we lose we lose control of that, and you've got new supply coming onto the market and 8% rates. That's the one that scares me a little bit. But
Yeah, I mean, Rob, I don't know what your take on this, but listen to the kind of Fed talk today, or our last couple of days. It's kind of like, I'm not really rooting for the Fed to cut rates. I'm kind of
yeah,
okay.
Rob's been
I
in that
think,
camp for
yeah,
yeah.
I mean, I think it could be a negative for mortgage rates, right? I mean, I think if all of a sudden we see a return to kind of runaway, not even runaway, just pumps
Mm.
up in inflation. I mean, I think that's a resounding negative. And I just I'm not smart enough to know for sure what the impacts would be, but in my opinion, I mean, I think they're doing the right thing probably right now for mortgage rates, anyways.
Yeah, the interesting thing about what you guys were just talking about, supply is actually, listings are actually up. And especially in places like Florida, there's a lot of unsold inventory right now. And I've also written about how builders inventory has been increasing somewhat because of unsold units. And Rich and I have talked about this before. Rich and I have talked about a lot of things before, but mortgage is only one piece of this affordability issue that a renter is looking at. And experienced loan officers, one of the first things they talk about when meeting a potential first-time home buyer is, well, have you thought about insurance? Let's bring in it. Let's get an insurance quote. How much is the HOA? What are the condo fees like? Because a borrower can beat a lender up over an eighth or a quarter, but if the if the HOA fees and insurance and so forth, property taxes are thousands and thousands of dollars a month, that easily blows the deal out of the water. And so mortgage bankers do what we can, Prosperity does what it can, but if the insurance bill is $2,000 a month, it's like, well, we can't help you there. And the Fed certainly doesn't control insurance costs, nor does the president or Congress. So it's a bit of a pickle, but I am seeing more for sale signs, and I am reading reports from builder publications that they are adding incentives to try to prompt buyers to come in. And you're right. At some point, not to go back to the ball peen hammer example, but at some point you get used to as a potential borrower, well, rates aren't going to go back to 3%. I know my neighbor's got 2 5/8, but we've outgrown this apartment. We need a place to live, and yeah, I'm going to pay 6.5. That's just the way it is. So yeah, I think the consumer adjusts eventually, and I think we're seeing an adjustment with consumer expectations.
Yeah, I'll just piggyback on kind of the insurance piece. I'm in no way an expert there. We do have an affiliate insurance company who tries their darndest to.
Of course you do.
Come on now. But I mean, listen, that's been very fortunate for us as we've kind of looked through every single option to try to save deals just in that scenario, right? And I'd say, okay, what can we do around it to try to save a deal or do this or that? But yeah, like Florida, yeah, I mean, you're definitely seeing inventory spike even in Texas, California. You're seeing them spike in these markets a little bit, more quickly than other spots. And again, that's a really, really tough spot where what's the solution there? I mean, it's not like they're going to become uninhabitable, so
Right.
it's just tough. And I mean, the other thing we're seeing is the same thing is happening to the condo associations behind it with insurance. So a lot of condo, associations have moved from warrantable to non-warrantable, which is a really, really difficult thing that we continue to attack, with Fannie and Freddie, especially as we focus on how do we switch this around, because we're really penalizing a huge group of people that already reside there that now have a much tougher asset to market than they did before because of rules that we've set. Do we have the ability to loosen these a bit or to think about them a little bit differently? Is a big focus as well. And I mean, I'm not just talking like, hey, that structure is unsound type stuff. We're talking, I mean, Rich, you were talking about Atlanta. Like Atlanta had a pipe freezing incident a couple of years ago, so all these water damage deductibles skyrocketed in Atlanta because the pipes could freeze at one point, and they're not set up for it. And then all these condos became unwarrantable. And it's like, guys, is this really the intention of what we're going for here? Like, can we figure this out and work through it? So yeah, I think you're dead on though. The nuance beyond just, hey, the mortgage rate, really, really plays into this.
So you mentioned putting on the whiteboard the Rocket, Redfin, Rocket, Mr. Cooper transaction. I mean, you being part of a Berkshire Hathaway conglomerate. I mean, it's you don't you own a like a moving company and I mean, isn't it soup to nuts that your originators can offer a potential borrower like, oh, you need help with that move? Well, we have this affiliate. Oh, you need some candy. Oh, you need, insurance. Oh yeah, I got your guy
So,
for you.
so,
Is that how
so
it
one thing
works?
about, I almost wish it did to some extent, even though that sounds real salesy. I just would love to think that I had it figured out to that degree where it was all connected. Like Berkshire's an amazing organization in the sense that it truly is what it says, which it's a holding company, right? So if we want to connect the dots with like a Geico, for example, we have to reach out to them just as if they were a company not under Berkshire, right? So Berkshire's not going to dictate what anybody does. We have to communicate like that. So whether they own, and I mean, you think about it, like Clayton Homes is owned out there, right? There's a lot of interesting things that are kind of adjacent or close to each other in terms of the marketplace. Or Benjamin Moore Paint, it's Benjamin Moore Sherwin-Williams, one of them, right? That or the Nebraska Furniture Mart. Like there's a lot of things that could connect here, but the bottom line is that's kind of on us to do. And we like to be core and focused around like the transaction, right? And so for us, really the focus is brokerage, real estate, title, insurance. Everything around there that's ancillary, yeah, I can kind of come into a play here or there, or in a local market if they have an affiliate doing something else or a deal. But for us, really, that's the core, because our goal is to, help someone find a house, get them into the house, have them safely protect the house, and then figure out what we can do around home ownership thereafter to help them be more successful in home ownership. Whether that be partnering with warranty companies or that kind of thing thereafter. So that's really the focus. A little less of the joiner honors, but there could definitely, there's definitely a lot of options. That's for sure.
When you have a parent like that, uh, how does change? How do you? Let's say you want to put in a new LOS or a new hedging company or a new CRM or whatever it might be. How how does that work? Can you just do it, or do you have to get approval from one or two layers up the ladder?
Yeah. So I'd say it's very professionalized. It's not necessarily slow, but it's very professional. So, as you present something up, you better have your ducks in a row and understand what's going on. You better have, here are the three options and the plans that I have. Here's how I'm going to kind of track it. Here's what I think it's going to be. Berkshire isn't scared of things as long as it makes sense. It's well presented. And then one thing that they always say is like, they want to trust the people running it. So I think you have to establish that trust as well, that we haven't really presented up to them like an LOS transition that would be that size and scope, right? But even something like hey, we'd like to expand into non-agency products, right? So non-QM type stuff, right? And as you move into that, that's something that Berkshire wants to understand, right? They want to say, okay, what is this like? Tell me about the market. Tell me what's happening, because they want to have massive intelligence in terms of the mortgage market and in general what it's moving. Okay, what's your risk profile like on this? What are we willing to do? Talk to me about it. Talk to me about the counterparty approval process. Talk to me about how you're gonna manage the counterparties after approval. Tell me how you're gonna manage your at-risk population and that sort of thing. So I'd say it's very professional, and again, it's not slow. But you really gotta make sure that you have a process in place, and Prosperity has its own board. That's kind of stop one, and then we move up to a board beyond that, which goes up into kind of like the energy company and that sort of thing. So, yeah.
That makes a lot of sense. And the reason why I thought about is when you mentioned non-warrantable condos and the transition to that, and to be able to capitalize on saying, wow, this is happening in the industry, and look at this whole non-QM sector, which that isn't that can be part of that, and to present that to somebody. Yeah, you want to be able to take advantage of that and not have it take a year and a half
Yeah,
to figure out.
The great thing about Berkshire is, I mean, just the best capital allocators in the country historically. So you present something up like that and you never know where it's going to go. It's like, okay, keep business as usual, or maybe it's, hey, we actually have an interest in this. Can we dig into it a little bit deeper and understand this a little bit more? Because it might be a spot where we want to allocate funds, from a different entity or from Berkshire proper or anything. I don't want to overestimate our importance in the world of Berkshire, but they do have a little bit of attention on the real estate company in general.
And Justin, Berkshire had, I think, was it four mortgage companies or three it was a couple years ago, 2, 3 years ago, right? They all kind of rolled under the Prosperity flag, if I'm not mistaken.
Yeah, so Home Services did, right? So even beyond us, there's Vanderbilt Mortgage, there's Silverton as well that exists under kind of the Clayton Homes
Okay.
realm, and I think there's another one, 21st, I believe it's called. So kind of those three that exist outside of Home Services. Then Home Services had Home Services Lending, Trident, and Prosperity. Trident wound down, and then Home Services Lending kind of merged into Prosperity in certain spots. So yeah, all under kind of that. Having three disparate systems out there is never efficient. So bringing anything under kind of one process flow, one set of one stack, et cetera, really helped us out.
It was a sad day for me because the other two were TMC members and you guys weren't. And then of course they all rolled up underneath you. I was like, oh, that is not a good scenario for but and Justin, you said something earlier that I've been hearing from clients pretty regularly last month. It's like basically the people are sick of waiting, right? We're now if it's you want to move to the next town or the street over or a new city state, it's been now 3 years, and right. And to Rob's point, like the high sixes, 7% rate market, it's starting to feel more normal. And it does feel like even if nothing changes from a rate perspective this year, that the rest of this year, it feels like it's going to be a little bit better maybe than the experts are predicting, but you're much closer to it than I am. Your thoughts on that?
So, I would say,
You don't want your goals to be raised. I hear you.
well, no, I'm just naturally a fairly conservative
Right.
person. I would say. I mean, I guess it would depend on who you're looking at. I mean, no, I do not think that there's going to be a break lower in rates.
Mhm.
Am I qualified to say that? Probably not, right? But
Mhm.
I go back to, I mean, we literally have had war in the Middle East and it hasn't moved rates. I
Yeah.
mean, my whole career, if that would have happened, I mean, I would have thought that was a big, quite the trigger to a flight to safety. And so, something has got to happen, right, materially in order for that to come down. So, what's going to drive it? I suppose the good, leading indicators are a little bit more inventory on the marketplace. It could be a little bit better. I mean, we're certainly seeing, I mean, for us, 17% of our activity is refinance. So a lot of debt consolidation out there in the marketplace, right? So I don't necessarily think we want a mortgage boom driven by people having run up a ton of debt and needing to consolidate. But that being said, it's reality. This consumer has been so strong for so long, and part of that has been their access to credit. So our ability to kind of put people actually in a better aggregate spot, versus the HELOC that they took out or the second or, just straight credit card debt is something that we're certainly seeing as a big opportunity, kind of in the broader market. I'd say that. But, I think we think we're in a really comfortable spot. I think, most everybody out there who's going to persist and make it through this year, they're probably, right sized. They're probably profitable. And so we don't need it to absolutely blow up in order to come back. But we actually kind of like these. We like rates to be a little bit stair steppy, because it gives people opportunity to consolidate down, and then hopefully refi them into a lower rate, right? So a couple transactions that help out the consumer actually isn't the worst thing that's ever happened before, like, as opposed to that huge drop at 3% where everybody in the world now needs to refinance, right? When we can more targetedly help pass clients out to fit their needs, and not worry about, I would say limitations in terms of support and operations and that sort of thing, but instead be a lot more targeted. We don't mind it.
Yeah, certainly if rates were to creep down, you have millions of borrowers who do have those seven rates in the sevens or high sixes that can benefit. You had mentioned at the start of the show that you are you licensed in all 50 states?
Everywhere but Hawaii at the moment.
So what's wrong with Hawaii? A lot of
Lava
people
zones. I
say,
can't
oh,
figure them
everywhere
out.
except New York.
No. Oh, New York is an awesome market. It's tough, but it's great. For us, Hawaii is the physical requirement. So we just have not had anyone raise their hand and say, "I'm going to move to Hawaii and open a branch for us." But that's the only one that we haven't quite opened yet. So.
Question in the chat about assumable FHA loans from our friend Mike Olden, that he's hearing more hubbub about that. It probably seems unlikely, right? Just given, I know there's been some delinquency spikes on FHA, and you have a, administration that seems kind of hell-bent at not having the government in the mortgage business. But Justin, anything you've heard or seen there on assumable FHA?
I got nothing on that one. Yeah.
Hmm. Rob, anything from your world? No, nothing. So, and I think with rates, it all really just, I mean, it feels like it does feel like the American consumer is taxed out just from prices and debt, certainly. And it does feel like inflation is in a position to subside, but it really all comes down to this tariff strategy. I hate to say it, like everything is kind of hinging on this. And the one thing nobody's talking about is what if this works? Like, we haven't even talked about it. Like, what if it works? Like, there's a lot of, they're doing it for a reason. There's a lot of smart people that believe this is the right thing to do. We did strike a deal today with England that I guess is going to be like 10% on everything. And at the end of the day, right, these countries need our consumers. So it's going to be interesting to see how that plays out. But, there is a path in a world where this tariff strategy actually works. And this administration, we know they're hell bent on bringing down the long end of the yield curve and mortgage rates. But, it's, I guess, just some food for thought that never gets kind of brought up. So I don't know who I'm asking that to. I know Rob doesn't.
I'll let Rob take that one.
Yeah. Next question.
Well, it's just
We're coming out pro tariff here today. Okay, all right, it's interesting.
We have like what 1 minute left or something.
Throw
2 minutes left.
Throw
Talk
that
about
question to Rob with 1 minute left. Yeah.
yeah. It's a complicated situation, and I think that what's interesting to me is that there's a lot of interesting things to me, but I kind of wonder what happened to Congress, frankly, to be blunt. But hopefully Congress comes back, and we've got a new pope. Rich, you didn't even talk about the new pope.
He's
from the
American,
USA, right?
American, I heard, right? American Pope.
It's not even Donald Trump.
Wow, I know. I can't believe Trump didn't weigh in with his thoughts on who it should be, So like but Mick Mulvaney or somebody, but
right. Mark Calabria.
Calabria would be a good pope. Yeah, listen, we've had him on the show. Would be good for the show. So Justin, any parting thoughts, your thoughts on the competitive landscape? There's all kinds of, obviously it's been just a crazy news cycle and crazy time for our climate. So to take us home, I'll throw you the mic to, take us home with some parting thoughts on the industry.
I mean, AI, wildly interesting. I just, I wonder, you look at it and even that prosperity size, right, which is right around, say, 8 billion, right? Like, I'm not really even like automating a lot of stuff with agents, agentic AI, basically, the next much better version of like, robots, right, out there. Like, I can't replace enough people for the cost to make sense yet.
Yeah.
Right. So like I look at it and I go, hey, this is a spot where like UWM, Rocket, they're going to have a huge advantage because of the sheer scope and size, right? So the economies of scale become so important in their ability to leverage this. But then I look at stuff like more on the sales side, right? And more the interaction with consumers and kind of handling leads and that kind of concept. And all of a sudden, I'm seeing really, really, really good use cases there where there's accountability in the bots because they just do it. And B, they're actually really, really good at performing the tasks, right? So you think about how fast that's going to iterate, and maybe in a year or 2 years, kind of that front line of sales associate that's really about incubation and about quick outreach and about speed to lead. I think that's a spot that's really, really interesting, that is going to allow people to scale a little bit faster in that space. The back office side, it'll come. It's just a matter of when and when it gets kind of cost effective enough, I think, to really make it so that it's a better solution than we have today.
Outstanding perspective, right? A company doing 8 billion a year in mortgages, saying very truthfully and rightfully that it's tough for us to find the ROI in AI yet. It's probably coming, but yeah, these bigger
it's coming for sure.
Yeah,
it's just not there yet, and I just think everyone can feel free and take a deep breath and admit that it's not necessarily that we're saying get off my lawn. It's not quite there yet. It's getting close, and we'll identify the spot to launch it, right, and to figure it out and to proof it. But I think in the sales end, the upfront sales end, I think it's going to be a really powerful tool.
Hey, Rob, our friend Brian Levy wanting to know how the new Pope will impact rates. You want any part of that question? No. Yes.
No.
All right. Well, good stuff. Justin, thank you so much for coming on. This was a great conversation. Really, really appreciate you making time and sharing your insight with our viewers and listeners. Thank you so much for coming on.
All right. Thanks, guys. Talk to you later.
And Rob,
Yes,
as always,
thank you.
good seeing you. And many thanks to our listeners and viewers. We are here live on Zoom every Thursday at 3 p.m. Eastern. Go to chrismancommentary.com to get signed up. And of course, this will release to pod and YouTube in about the next 10 minutes. So want to thank Justin once again, Rob, our viewers, listeners, and we'll see you next Thursday, everyone. Have a great
Thank you,
day,
Justin. Thank you, Depth.
guys.
Adios.
Step.